The providers we speak to are seeking to provide value for money to their customers, and I think the key here is to use the positive intent of this regulation to further enhance their business plans. And those that prove to provide better value for money, I expect will win more schemes and customers and retain them for longer.
You're listening to Rethinking Insurance, a podcast series from WTW where we discuss the issues facing P&C, life, and composite insurers around the globe, as well as exploring the latest tools, techniques, and innovations that will help you rethink insurance.
Welcome to a new episode of Rethinking Insurance. I'm your host, Hjoerdis Gerke, and today we're going to look at the UK Accumulations and Savings business and why the value for money concept in the context of workplace pensions can be hugely valuable, not only for the UK, but also cross borders. But before we dive deep into today's topic, I'm delighted to introduce you to our guests, Philip Tervit and Kris. Welcome to both of you.
Thank you.
Hjoerdis.
Nice to be on the show.
So Phil, as a senior director at WTW, you have over 20 years of experience in the insurance industry. You are leading the accumulations and savings business on behalf of insurance consulting and technology. And in that role, you are taking our software and consulting offering to the workplace investment platform and asset manager clients in the market. But we also want to know some fun facts about you. So as you may know, as part of the prep work, we always Google our podcast guests and to see what turns up. And interestingly, I have found a fundraising website you set up in 2011 when you ran the Edinburgh Half Marathon with your sister for charity purposes. At least I hope that was you.
That was me.
That was you. And you already declared it a one-off birthday gift to your sister back then and admitted that you didn't necessarily finish in record time. So how did your running career go on? Where are you today? And is running something you still enjoy or never did, actually?
That's funny that you found that on the internet. Yes, I did do that. And that was quite a painful experience, having done very little training back in 2011. I do still run it. I very much enjoy it, and I have done a few marathons since, and one upcoming in a couple of months' time. So back in training mode.
Sounds great. And another very warm welcome to Kris. Welcome to our podcast and welcome to WTW. You just started working with us end of last year as an accumulations and savings director, also in the UK. And of course, I was quite curious to also Google your name. But as expected, you're not the only Kris Black in the world. So unless you have a second life as an author, cartoonist, or fashion designer, what were you doing before joining us? And what do you want to achieve in your career at WTW?
Sure. Yeah. I definitely wasn't a shoe designer. I think I've Googled myself in the past as well. I think that was one of the ones that comes up here, different Kris Black. I joined in December. I'd previously been working for Aviva for nearly sort of 20 years. Come to WTW to help build out the accumulation segment within the UK. And I suppose what would I like to achieve at WTW is that really I think accumulation and savings for us at the moment is a new growth area. So I'd like to build our presence in the market, make sure that the accumulation and savings segment sort of punches its weight compared to some of our other segments. And I guess ultimately I'd like to be able to help our clients to succeed in their business goals and help our clients to ultimately help their sort of the end members, their savers, get the most out of their products and certainly in secure the best possible retirements they can ultimately.
Good to have you on board.
Thank you very much. Good to be here.
So maybe let's start with some definitions. Value for money. What is it all about, and why is especially the UK currently focusing on VFM or value for money?
So value for money is really a framework to assess the quality of a workplace pension solution for its customers and members. We're really in the world of defined contribution pensions here, and holistically, what value for money is covering is really a range of value. It's not just about charge levels, but the full package of what the customer receives.
And why is the UK focusing on VFM right now?
I guess this is really part of a journey that was first brought in with auto-enrollment some 10 years ago, where essentially individuals are being asked to save for their own retirement. And that shifts a lot of responsibility to the individual to think about their own financial well-being and retirement. And one of the challenges here being faced by individuals in the industry is whether they have all the information with which to make those choices. What investments will they make? What products do they need? How much do they need, etc.? Have they got the information with which to make those decisions? And advice, there's an advice gap in the market, which we'll come on to talk about. And I guess this is just fundamentally a key pillar of retirement planning, both individually and as a society.
So at first glance, it seems that the VFM concept is very UK specific, but as mentioned at the beginning, the topic might be also relevant for other markets or international listeners. Could you explain to us why that is?
The principles of value for money absolutely go beyond the borders of the UK, where there's defined contribution savings, as there are in a number of markets across Europe and beyond. The concepts that we'll talk about on this podcast are very much relevant to other regions of the world as well.
So why is value for money particularly pertinent right now?
So I guess one for me, I guess the UK regulator, they've done quite a lot in this space in the past. But I think that the key thing that's changed is, as Phil mentioned, auto-enrollment for pensions kind of kicked off in the UK around about 10 years ago. And obviously, with any sort of new proposition or new development, it started slow and then built up gradually over time. So I think now what we're starting to see is that those members who've been paying the contributions for the last 10 years, or maybe it's only sort of 5 years, depending on what sort of employers they've been in, they're starting to really amass some quite sort of sizable DC pots. So the regulator sort of needs to treat these a little bit more seriously in some regards. So, when you're looking at smaller pots, possibly value for money wasn't at top of anyone's agenda, but as the pots grow, making sure that people really do get the best value for those larger pots is absolutely sort of paramount. So I think now it's really a part of almost growing up, I'd say, for DC pensions in the UK, really.
And how's the UK regulator looking at VFM?
Looking at it through a number of sort of different lenses, which I'm sure we'll come on to, as Phil mentioned. I mean, charges and costs have been probably a key focus for the UK, and I suspect that's in some regards been because it's an easy metric to look at. So I think when you think of value for money, the value bit can be quite subjective, so it's a little bit more difficult to really pin down. But when you look at the costs and the charges, that's a numerical number. It's either a percentage of an asset or it's a pounds amount, and it's a little bit easier to benchmark people against. So I think the regulator in the past had focused quite a lot on charges, and I think they're moving more towards value and actually what people get from it. So hopefully that will be really good news for everyone, because I think just a one-dimensional view of charges really doesn't tell the whole picture with DC pensions.
And just adding to that, Kris, as you allude to, there's things like service metrics. What's the quality of the servicing? What's the overall sort of consumer duty perspective, the end outcome for the customer, as well as the quality of the investment offering, or indeed the governance arrangements around the workplace pension being provided. So that starts to get to the more holistic view of value.
Yeah, absolutely. There's a range of different metrics, and I think there's some consultations in the UK at the moment which are proposing some of those things. And obviously, people have created their own sort of value for money benchmarks. WTW have been, probably market leaders in this space, I think, for the last few years. So it'll be certainly an interesting place to see how the market develops over the next few years, really.
Coming back to consumer duties regulations, how are they different to assessing VFM?
No podcast would be complete at the moment without mention of consumer duty. This is a UK regulation, but similar to VFM, there are sort of elements here that go beyond the borders of the UK. It's setting a principle that the regulator is keen that customers or members get good outcomes from their policies. It's applicable wider than workplace pensions. It applies to all insurance products, in fact, wider to financial services too. With VFM and consumer duties, some of our clients are struggling with two overlapping regulatory regimes currently, and so that's a key concern currently and a key challenge. But one particular area is more where consumer duty is particularly applicable is on heritage or legacy type contracts, which might be policies that were sold in the past to save for retirement, but are perhaps more complicated than the current versions.
So would you say customers in legacy contracts would be better off in a new contract or fund?
So we know some clients are looking to help their customers move to more modern products. And that might mean upgrading or moving existing policies into a more modern equivalent. But caution is needed here, as some legacy contracts may have particular options or guarantees or bonuses. So caution is needed when doing such a program.
Can a provider legally do anything about that?
Yes, there are options available to do so, but it's not an easy path. But it can have real benefits for its customers if it's delivered successfully.
Okay, so would you say that the focus on VFM is all being driven by regulation?
I wouldn't say it's all being driven by regulation. So there are a number of different regulators, as Phil mentioned, that work in the UK, and they're getting together to produce a bit more of a holistic view of VFM. But I mean, the concept of VFM obviously has been around for a number of years, and all of WTW's clients, the DC providers in the markets, have been looking at this for a number of years. I mean, ultimately, value for money is a measure of what a provider's clients get from that provider. So when you're looking at a competitive market, the more VFM you can offer to your clients, then the more business you should win, the more business you should retain. Your clients should be happier, and that sort of virtuous circle that you sort of see of happy customers, happy shareholders should hopefully ring true here. And I think from a WTW point of view, one of the things that we've always done is start looking at providers from that benchmarking point of view. So one of the things you find with DC pensions is that a lot of people don't necessarily understand exactly what they have at the end of their journey. So that's true for employees, but it's also true for sometimes for employers or trustees of these pensions as well. So actually, they need specialist advice to help them to navigate some of this complexity. And I think that's an area where WTW in the past have always worked quite closely with those employer customers, really. And I think it's probably another area which we'll continue to focus on in future.
So delving into VFM further, can you expand on the factors used to determine VFM?
There are a lot, and the ones that I think we'll look at and the ones that the regulator are focusing on are certainly a subset, but it's not to say they are the be all and end all. But the key ones that the regulator are looking on are probably sort of investment returns. So looking at the actual returns that members get from the funds that they're invested in. They're looking at that on a number of sort of different bases. So that they want to look at it sort of net of charges and gross of charges and possibly net of just investment charges. But they'll look at that historically, probably over a number of different years. But they're also going to start looking at sort of risk-adjusted returns or the volatility of those returns. So I think we'll start to see a relatively complicated picture emerging, just in terms of the investment returns that members of different funds are getting, really. So that's certainly one pillar, and probably the most important one in terms of actually determining what somebody actually retires on or how large their DC pot is at any particular point in time. The other one we've already mentioned is charges. So, what do people pay for the pensions that they're invested in? And this is an area where I don't know how it compares internationally, but certainly the UK is relatively opaque in some regards. And that's not a bad thing per se, but what you do find is that individual employer pension arrangements tend to be bespoke priced. So everyone has their own individual price. That's not people are hiding things behind closed doors. That's just the way the market works, and these things aren't necessarily published. So, the regulators themselves are sort of trying to sort of say, look, they would like a little bit more transparency in some of those charges and what people are paying. But it is a key focus and has been for a number of years, really. Phil, there's a couple of others. Do you want to touch on those ones?
Yeah, there's a couple of other points here. So I'll just touch on servicing for a moment. So customers, whether they need to switch funds or have a life event, inevitably they need to engage their provider at that point of need. And what is part of a value concept is to how well you service those customers, how quickly and how robustly do you help them with the issue at hand? And so this is something that providers have been challenging themselves with for some time. They'll have some kind of service level standards they seek to provide. But how good is that, and how comparable is it to their peers? And also, is it actually meeting their increasing customer expectations to do things more digitally and quicker than ever before? So that's something we talk a lot about, end-to-end processing, and our DC research team are absolutely sort of market leading on having a good awareness of how strong the market is, and comparing and benchmarking firms against one another, which takes you onto a wider piece of customer journeys and what the overall sort of product offering is, and how you help individuals through the different stages of their pension saving and into retirement. This is a really topical area as, I guess, DC pensions become the first and foremost port of call for retirement income as it replaces defined benefits. So how do you go to and through retirement, and what are the product offerings and customer journeys to facilitate that?
So there's a lot of new input and information. Who will be the audience for this? What do you think?
The key audience for all this value for money information is really first and foremost going to be the large employers, the trustees of the master trust schemes or own trust schemes. The independent governance committees have a key role, as well as the providers. I think the end customer and also the employers will be interested in this too, albeit there is a difference between the large employers, where this is going to be key, and smaller employers who really just kind of want a more simple, straightforward solution, which are available in the market. But value for money at its heart, if we get it right, will really support all customers that have a DC pension arrangement, which is mandated in the regulation, and therefore it should help most people in society.
So what is the increased regulation aiming to achieve?
So ultimately, this is really looking to improve value for money for end customers, and as part of improving value for money, looking to improve trust in the industry from the end members as well. So, a lot of these products aren't necessarily that well understood by customers, but this will hopefully aim to improve customer understanding. And if not improve customer understanding, it gives information to kind of trusted advisors, so that you can maybe more positively delegate some of those decisions to other people. But one of the things I think the regulation is not necessarily clear on is, like, whilst they would like to improve VFM, that exactly how that'll happen is yet to be determined. But I think with this information that should be published, and you should see benchmarking standards start to occur, then schemes will be able to compare themselves a little bit more easily from provider to provider, and hopefully that really drives an increasing sort of hurdle rate that people have to overcome to really sort of succeed in this market. And I think it's, that will be a double-edged sword. I think for providers who can keep up with that increase in the benchmarks and the hurdle rates, then they should really win out of this one. But it really does create a risk that if you can't keep up, then from a provider's point of view, you risk being left behind, or even sort of the worst case scenario, forced to exit this market. But yeah, ultimately regulation looking to improve value for money for the end customers.
And do you think that this is the end game for VFM in the UK?
No, certainly not. I mean, I think even the consultations that are out at the moment would recognise that. So, and I think it's quite a positive, really. It's any kind of new area which is a little bit difficult to grasp. And I think starting small and building out probably is the right approach to take. So, some of these changes that regulators will impose on providers, they're not cheap for people to comply with and to implement. So the idea of sort of starting small and building out, I think, is absolutely the right one to look at. So the metrics that have been talked about at the moment, like I said, investment returns, charges, servicing, customer journeys, they'll start there. They will expand. People will look at refining those ones. New metrics will come in. I think the service in particular is really an area where people aren't quite sure exactly how to benchmark that, and what good service really looks like. So I think that is an area which will definitely develop over time. I think the other thing, as we mentioned at the start, this is this is very much a workplace defined contribution pensions focus at the moment. However, there's already talk about this being expanded into more individual pensions. And I think once if it goes there, then there'll be other sort of savings type contracts which are sort of naturally quite similar. So you would see it sort of expanding into there as well. So yeah, I think the metrics being looked at and I think the products being covered will expand over time.
So before we come to an end, do you have any advice for providers of workplace pensions? What opportunities can they take from the current focus on VFM?
The providers we speak to are seeking to provide value for money to their customers. And I think the key here is to use the positive intent of this regulation to further enhance their business plans. And those that prove to provide better value for money, I expect will win more schemes and customers and retain them for longer.
So what would be the key takeaways for our international listeners?
I think some of the challenges here are faced in other countries too, where there's a move to pass the onus of retirement savings and financial well-being on the individual. We've seen that in a number of countries at different stages in that journey. And in each case, there's the challenge of have the individuals got sufficient information, and are they saving enough, and are they making the right decisions with that information in mind? So the concepts of value for money are obvious in many ways. Is the individual getting the product that they need and being serviced accordingly and have the options available to them at the time that they need to make those decisions or take up those different investment options, for example. So in some ways, the concepts we've discussed today apply whether it's mandated by regulation or not. And I guess the other thing we've seen in the past is UK regulation can be seen or considered elsewhere by international regulators, for example, and the information will become open for others to see and maybe adopted elsewhere in the future.
Having a look at some of that open information could be interesting for some of those international audiences as well. So if you look at some of the things that the UK is publishing, and if you benchmarked yourself against some of those UK standards, there may be things that you think, look, the UK is doing better than we can. And that gives you an opportunity to find out how and why. If there are things that you're doing better than the UK, then maybe there's potential markets that people could open up into the UK as well. So I think, just even this open sharing of information, I think we've seen numerous times across different industries that once the information exists, then new and unexpected and hopefully positive things will come out of it.
So ultimately, how can we as WTW help our clients in assessing VFM? What do you think from your experience?
This segment of the market is really fast moving, and the value for money regulations have added an additional both complexity, also a regulatory timeline and emphasis on this area. So I think first and foremost, the discussions we are having are helping clients navigate the regulatory complexity. And that is with the providers as well as the trustee boards and the independent governance committees, who they themselves have to meet regulations in this space. We already offer a range of value for money services, whether that's analysing the quality of the investment default fund or benchmarking your servicing to your customers. These are things that are almost like a menu of support that we can provide in respect of value for money, and help clients ultimately improve their propositions through innovation and insight. So what are the products that allow your customers to move to and through retirement is a very topical area, and one that we are using innovation to think through solutions. But ultimately, our goal at WTW is to help providers or the IGCs and master trusts to create a business that offers fantastic value for money for both their customers and ultimately their shareholders too. Not an easy balancing act.
I think that was really interesting. Actually, I learned a lot today. Thank you both for joining me today. And yeah, it was a pleasure. Thank you.
Thanks, Hjoerdis.
Thank you very much.
And thank you, listeners, for joining us for this episode. And if you found this interesting, then make sure to join us on future episodes of Rethinking Insurance.
Thank you for joining us for this WTW podcast featuring the latest perspectives on the intersection of people, capital, and risk. For more information, visit the Insights section of WTWCO.com.